Happy New Year, everyone. This is Patrick from AllQuant. 2022 turned out to be the kind of year that has not been seen by a generation of investors. After being lulled by low inflation and a low interest rate environment for more than a decade, inflation roared back with a vengeance and central banks hiked rate aggressively in response. Let's see how the strategies taught in our course performed during this challenging period. As usual, we will start by getting a sense of the kind of market environment that defined this year. We will then look at how the individual strategies performed and whether it is in line with their expected behavior. We will then look at the overall multi-strategy performance. This year has been dominated by the overall macro theme of inflation. Both stocks and bonds went down together, with bonds performing worse than stocks. Needless to say, this was tough for most balanced or multi-asset portfolios out there, especially those that relied heavily on bonds. Long-term treasuries, as represented by TLT, behaved like risky technology stocks. Our risk parity allocation did not change much throughout the year, with the bulk allocated to IEF. And since both SPY and IEF went down together, coupled with the use of leverage in the strategy, risk parity suffered its worst year in history, and this is to be expected. Note that this is a simple two-asset risk parity model. With more asset classes in the portfolio, the performance might be somewhat better, but it would also be down. Even commodities gave back some of the first half gains it made during the second half of the year. Looking around at some of the large risk parity funds out there, they are also suffering one of their worst periods since their inception. So the performance that we see here for risk parity is not unique, right? And in fact, it is to be expected. For our trend following model, the exposure to stocks was around 110% at the start of the year. It only seriously started reducing exposure after April, and it ended the first half with slightly less than 70% exposure. It continued to trim exposure until it hit about 40% in September. It then gradually increased exposure as the Dow Jones Industrial Average recovered strongly in the fourth quarter. The model ended the year with about 80% exposure to stocks. Overall, it is to be expected that trend performance is roughly in line with the DIA, which is the ETF tracking the Dow Jones Industrial Average. The difference is only in the lower volatility experienced by the trend model, as compared to DIA. This is testament to the defensive quality of the trend following strategy. 2022 can be considered a volatile year, with the VIX oscillating between a wide range of 20 to 40. As a result, our volatility risk premium model was kind of a wild card. Performance depends on how it reacted to changes in the volatility risk premium. The model didn't do so well during the first half, but it performed very well in the second half. In the end, the strategy managed to generate positive gains for the full year. 2022 turned out to be a year where sector rotation would have been better off without its natural hedge. If sector rotation was run without any hedge, it would have only lost about 3% this year. This is attributed to the fact that sector rotation allocated mainly to the defensive sectors of consumer staples, healthcare, and utilities. But even with TLT dragging down performance, sector rotation still did better than SPY for the full year, and this is also in line with expectation. This is the 2022 performance of the different sectors in the US market. It was quite a mixed bag of performance across the sectors. The energy sector, as represented by XLE, performed spectacularly this year. Unfortunately, it was too volatile to warrant any allocation into it. The consolation was the strategy allocated mainly to the defensive sectors, and they lived up to their name and they were resilient. This was what helped our sector rotation model buffer some of the losses from TLT. The combined multi-strategy portfolio outperformed S&P 500 for the full year. More importantly, the multi-strategy portfolio's performance is less volatile than that of the S&P 500, which experienced more drastic moves. The multi-strategy portfolio also experienced a much smaller drawdown than the S&P 500. This is the expected resilient nature of the multi-strategy portfolio. In summary, this year is challenging for risk parity because both stocks and bonds went down together. However, the other strategies helped to stabilize the multi-strategy portfolio. Volatility risk premium is the star performer for 2022 since it was able to stay profitable in such a challenging environment. The other strategies are also doing what they are supposed to do, just that this is a unique period that is tough for both stocks and bonds. Overall, the multi-strategy portfolio did better than SPY and was more resilient on the downside. This is in line with our expectations. Okay, so this is our model updates for 2022. Let's look forward to a better 2023.